Imagine you're the best poker player alive. Imagine you know the probabilities perfectly. You know when to call, bet, fold, whatever. You know how the probabilities pan out. This is called having positive expected value. Over time, you should make money because you're playing the probabilities flawlessly. But even still, if you sit down with a tiny stack of chips, if you get dealt a couple bad hands in a row, you could be out of there. You can go bust just by having a couple bad beats. It's the same deal with trading. If you sit down and you have a little tiny baby account, you're gonna need a little luck to get by. If you have a few bad trades in a row, even if you're playing the probabilities just right, because trading is very much a probabilities game, you can blow up your account, and that's just a fact. So trading with a small account is tough. You can do it, but it is tough. I think there are 3 ways that people tend to approach trading with a small account. And in my opinion, some are better than others, but we're gonna cover all 3 of them. The first approach is by just YOLOing your money. You only have 200 bucks. What can you afford? Out of the money options, they're cheap. They provide you with a significant amount of leverage, but really they're more of a gamble than anything because they have such high break-evens and theta degrades such a large percentage of them that you really have to hope that the stock moves quickly. I can't say that I haven't tried an earnings bet before. When I was first learning options, that's exactly what I did like 3 times in a row, and I lost all my money, even though one of the times it went the way I expected because implied volatility collapsed and it did not move far enough. People buy out of the money options hoping that the stock price moves quickly because they know that time decay is going to eat away at their premiums quite fast. So the best way they think to do this is by buying before an earnings call. But what some people don't realize is the expected move of the stock is already priced into the premium of the option. So you're paying more for this out of the money option. And then once that expected move occurs, if it's not outside, if it's not more than what was anticipated, if say people thought it was going to move 8%, options were priced in to reflect that kind of volatility, and it doesn't move past 8%, what ends up happening is even if it goes the direction you expected, your premiums are going to collapse because implied volatility collapses. People no longer want these options. They don't expect any volatility coming up in the near future. The binary event has passed. Your premiums collapse. So if the stock doesn't move quickly, or if you get what's called IV crushed, if implied volatility collapses, which happens after earnings, and that will diminish your premiums, then you're out of money again. In that kind of scenario, you have negative expected value. You're not playing the probabilities correctly, you're just hoping to get lucky. And there's no worse feeling than betting money on an earnings play and then watching it just evaporate. Like my twin brother, Eric, he's my identical twin brother. I remember one morning, he was thinking of doing an earnings call, and I was telling him, please don't do it, because I've done it before multiple times, and none of the times has it panned out well. I told him, don't do it. You'll always regret it. It wasn't that much money that I was betting at the time. It was like $450, but he was a college student, so that's a lot of ramen. And things didn't go the direction he planned. And it's not just a coin flip, it's a weighted coin flip, because even if it goes the direction you anticipated, if implied volatility collapses too much, you're still going to lose money. Don't take my word for it. Let me get him and actually let him tell you how he felt. Tell him how you felt. Tell him how you felt. Feel good or bad?
It felt horrible.
There you go. Thank you. Bye-bye. Awful. If you're trying to take it seriously and you want to actually stay in the game for a long amount of time, buying out of the money options as a trading strategy, generally not going to prove worthwhile. Yeah, maybe you'll win. More likely you'll lose. So that's one approach, is buying out of the money options. Another approach is trading spreads. You only have so much to trade. Maybe you want to diversify your trades into a bunch of different underlyings. Well, if you want to make options cheaper, you buy a call and you sell a call against it, or buy a put and sell a put against it. That's going to reduce the overall cost of the trade. It's going to reduce the capital at risk. Sure, it's going to limit the max profit you can make, but at least it's going to be cheaper and you can diversify your trades a little bit. I think this is a fairly decent approach to trading with a small account, but there are a couple issues with it. The first is the bid-ask spread. If it's really, really small, if you're really lucky, it's going to be just a couple of cents wide. But if you're only trading with 200 bucks, that means to get in and out of the trade, to buy at the ask and sell at the bid, or vice versa, you're giving up $2 per trade. And that's 1% of your count. So just to get in and out is going to be 1% of your count. And this is assuming that you have positive expected value, that you're going to actually be trading well. But as a beginner, you're probably going to have negative expected value, which means, right now you're probably going to not be playing the probabilities correctly, and you're going to be more than likely losing a little bit of money. So you're eating away into your capital with the bid-ask spread. And then you're also eating away into your capital because you're just trying things out. You're just starting out and learning. Not only that, but if you're trying to have a nice plethora of diverse trades, you're probably going to be limiting your max profit quite a bit. To make those trades cheap, you have to sell a call pretty close to the call you bought, or put, whichever type of spread you're doing. And what that's going to do is it's going to reduce your max profit by a significant amount. So the bid-ask spread is eating into your capital. You probably have negative expected value, which is going to eat into your capital. And then your max gains on these trades is not going to be that high anyway. So is it really worth it? So you can do it. I'm not saying you can't. And it's probably more likely that you'll be successful and at least be in the game longer than if you're trading out of the money options. But I think the best way, in my opinion, is this third approach. And that approach is don't trade options. And I kind of hate saying that, but once you save up enough money, maybe like get up to $1,000, you have so much more to play with. You can handle having a few bad beats in a row. You can handle the bid-ask spreads, and you have enough time to practice to the point where you might actually get positive expected value. If you start with $200 and you lose those $200, and the next month you throw another 200 in and you lose most of that, and the next month you throw another 200 in, it's just, you're just restarting every month. You want to have a nice juicy amount of capital to play with. So what I would suggest is just throw $200 in your brokerage account. And then the next month, throw another $200 in. Do it again and again and again until you have about $1,000 in your account. And then probably should still stick to spreads, but then you can handle all the things we've just discussed. Sometimes the best answer is the least fun answer to hear. And that is exactly the one I'm giving you. It's don't trade options right now. Save up until you have a nice pillowy cushion of cash. So I know trading is all about being very active, but sometimes there are moments where you need to be patient, and this might be one of those moments. In the meantime, it doesn't mean you can't trade. There's platforms like Thinkorswim by TD Ameritrade where you can paper trade all you want, and you can practice all sorts of different strategies and take this time to learn what kind of trader do you want to be? What kind of strategies do you want to try? Learn how different option strategies work and what other people's approaches are to the markets, because everyone's approach is a little bit different. Thanks for watching, guys. I'll see you in the next one.